Welcome to our final video in our series on absorption and variable costing. In this video, we are going to compare the profits achieved under absorption and variable costing, explain why they are different, and reconcile them. We are going to jump straight into our comparison and begin by revising the key differences between absorption and variable costing. Once we have remembered the key differences, we are going to use an example to understand the consequences of these differences on our profit statement. Finally, for each example, we are going to reconcile the profits between absorption and variable costing. Let us begin by comparing the per unit calculation between absorption and variable costing. You should remember from our previous videos that absorption costing takes into account all costs involved in the production process. This includes direct materials, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. Variable costing, on the other hand, only considers the variable production costs, which include the direct materials, direct labor, and variable manufacturing costs. Therefore, the key difference between absorption and variable costing is the treatment of fixed overheads. Absorption costing capitalizes the fixed overheads to the product, while variable costing expenses them immediately. What are the implications for our profit statements? First, remember that absorption costing has a gross profit line, while variable costing has a contribution line. This is because absorption costing splits the costs based on function. Do they relate to the manufacture of the product or not? Production-related costs are presented above the gross profit line, whereas non-production costs are presented below the gross profit line. Alternatively, variable costing splits the costs based on behavior. Are the costs variable or fixed in nature? Variable costs are presented above the contribution line, whereas fixed costs are presented below the contribution line. Also remember that absorption costing has an under or over recovery of fixed overheads. We don't have this under variable costing. Now, because of the different treatment of fixed costs, we have two different profit formula for absorption and variable costing. The variable costing net profit is very easy. It is simply the contribution margin multiplied by the units sold and less the fixed costs. You will see here that variable costing is a function of our sales only. It is a very important formula to remember, as it will help us with our cost volume profit analysis. Now let us consider our absorption costing profit function. We will begin with the same function as variable costing. Remember, however, that we unitize the fixed manufacturing costs. Therefore, we need to subtract these from the unit contribution margin before we multiply it by the units sold. The next thing we need to do is account for the under or over recovery of overheads. To do this, we need to add the fixed manufacturing overheads absorbed into production. Remember, the unit fixed cost multiplied by the units produced represents the absorbed overheads. The actual expense is included in the fixed costs we are already subtracting at the end of the formula. So the difference between absorbed and actual represents the under or over recovery. As you will now see, the absorption costing net profit is a function of both sales and production. We will see how this plays out in the next few examples. Let us look at an example to see how these different profit functions play out. Pause this video, take a moment to read through the scenario, and try to prepare the absorption and variable costing income statements. When you are done, resume the video and we will work through it together. When preparing an absorption and variable costing income statement, the first thing I always like to do is prepare the cost per unit calculation and the stock reconciliation. If we look at the cost per unit, the variable manufacturing cost is given to us at 200 Rand per unit. Now remember, variable costing does not have any fixed manufacturing cost included in the product cost, so it is not applicable. For absorption costing, we will need to calculate our overhead absorption rate. In this case, it is very easy, as it is a plant-wide rate based on the number of units produced. So, we can simply divide the total fixed manufacturing cost of 250,000 Rand by the normal production of 10,000 units to get 25 Rand per unit. This gives us an absorption cost per unit of 225 Rand and a variable cost per unit of 200 Rand. To complete our stock reconciliation, the opening stock was given as 2,000 units. Production was given as 10,000 units and sales was also 10,000 units. We can then calculate our closing inventory as 2,000 units. Now let us move into the statements. We will begin with absorption costing. We can start with sales, which is the 10,000 units sold multiplied by the selling price of 300 Rand per unit. Our opening inventory is the 2,000 units we just saw multiplied by the 225 Rand we just calculated. Likewise, production is the 10,000 units produced multiplied by the 225 Rand. Finally, our closing inventory is the 2,000 units closing stock multiplied by the cost per unit of 225 Rand. We can then calculate our cost of sales and our normal gross profit. To calculate our under over recovery, we take the absorbed overheads, which is the 10,000 units produced multiplied by the 25 Rand per unit, and we subtract our actual overheads of 250,000 Rand. Remember, we subtract the actual overheads incurred when preparing our actual income statement. When preparing a budgeted income statement, we subtract our budgeted overheads. We can then calculate our actual gross profit. The last thing we need to do is subtract our non-manufacturing costs. Our fixed non-manufacturing costs are given to us at 60,000 Rand. Our variable non-manufacturing costs are the 5 Rand per unit multiplied by the 10,000 units sold. We can then calculate our net profit as 640,000 Rand. Now let us do our variable costing income statement. Our sales is the same as under absorption costing. Our opening stock now changes. Instead of multiplying the opening inventory of 2,000 units by the 225 Rand per unit, we multiply it by the variable cost per unit of 200 Rand. The same applies for our production costs and our closing inventory. This gives us our variable cost of sales of 2 million Rand. This is a key difference between absorption and variable costing. We can then subtract our variable non-manufacturing costs, which is the 5 Rand per unit multiplied by the 10,000 units sold. Very importantly, the variable non-manufacturing costs are above the contribution line, but they do not form part of the production cost. We can then calculate our contribution and finish off by subtracting our fixed manufacturing and non-manufacturing costs, which are both given to us. We can then arrive at our net profit of 640,000 Rand. Notice in this scenario that both absorption and variable costing have the same net profit, so there is no need to perform a reconciliation. We can therefore conclude that when production equals sales, the absorption costing net profit will equal the variable costing net profit. Now let us change the scenario slightly. Instead of producing 10,000 units, we will now produce 12,000 units. Everything else remains the same. Let us see how this affects our income statements. Again, pause the video and give it a try on your own. When you are ready, we will work through it together. Let us start again with our cost per unit calculation and our inventory reconciliation. Only the number of units produced changed, so nothing changes in our cost per unit calculation. Our absorption cost per unit remains at 225 Rand, while our variable cost per unit remains at 200 Rand. If we look at our inventory reconciliation, we start off with our opening stock of 2,000 units. We then produce 12,000 units and sell 10,000 units. This leaves us with closing inventory of 4,000 units. Let us see how this change impacts our income statements. For absorption costing, our sales stays the same. We are still selling the 10,000 units at 300 Rand per unit. Our opening inventory also stays the same. Our first change is with the production costs. Remember that we produced 12,000 units, so we multiply this by the 225 Rand. Our closing stock is also different because we now have 4,000 units of closing stock. We can then calculate the cost of sales and the normal gross profit. To calculate the under or over recovery, we take the overheads absorbed, which in this scenario is the 12,000 units produced multiplied by the overhead absorption rate of 25 Rand per unit. And we subtract our actual overheads of 250,000 Rand. Here, we see that we now get an over recovery of 50,000 Rand. We can calculate our actual gross profit and subtract our non-manufacturing costs like we did before. Notice that our variable non-manufacturing costs have not changed. This is because they are based on the units sold and not the units produced. We can then arrive at our net profit of 690,000 Rand. For our variable costing income statement, our sales and opening stock also remain the same. Our production costs are now based on the production of 12,000 units, while our closing inventory is based on the 4,000 units. We can again arrive at our variable cost of sales of 2 million Rand. And we can deduct our variable non-manufacturing costs to arrive at our contribution. We can then subtract our fixed costs that were again given to us in the scenario, and we arrive at a net profit of 640,000 Rand. Notice this time that our net profits are different and will therefore need to be reconciled. You will also notice that when production is greater than sales, our absorption costing net profit is greater than our variable costing net profit. Let us consider the reconciliation. I like to do it in this layout where we separate the fixed overheads in opening and closing inventory, as it accounts for issues when the fixed overhead rate changes between years. So we already have our absorption and variable costing net profits, which we just calculated. If we are then working from absorption costing, we need to ask how our fixed costs would have differed if we had used variable costing. Remember, absorption costing would have expensed the fixed overheads in opening stock in the current year when the units produced are actually sold. Variable costing, however, would have expensed it last year when the overheads were incurred. So because absorption costing expensed it this year, but variable costing did not expense it this year, we need to add it back. And the amount we add back is the units in opening stock multiplied by the fixed overhead absorption rate, which applies to our opening stock. For our overheads in closing inventory, absorption costing does not expense them this year, but rather carries those overheads forward to next year to expense them when the units are sold through the opening stock. Variable costing, on the other hand, expenses the fixed overheads this year when they are incurred. So absorption costing expenses it this year, but variable costing does not. So because absorption costing did not expense it this year, but variable costing does expense it this year, we need to subtract it. The amount we need to subtract now is our closing inventory multiplied by the fixed overheads in our closing inventory. This then reconciles our absorption and variable costing profits. Let us move on to then our last example. In this example, we have units produced of 8,000, which is less than our units sold of 10,000. Everything else remains the same. Again, pause the video now and work through this example on your own. Unpause it when you are ready to continue. Our cost per unit calculation remains identical to previously. With our inventory reconciliation though, notice that our production now is only 8,000 units. This means that our closing inventory will now be 0. Now let us prepare the income statements. For absorption costing, again, our sales and opening inventory remain unchanged. Our production costs are now based on the 8,000 units at the 225 Rand per unit, and our closing inventory is null. We can calculate our cost of sales and our normal gross profit. To calculate the under or over recovery, we take the overheads absorbed, which is the 8,000 units produced, multiplied by the overhead absorption rate of 25 Rand per unit, and we subtract our actual overheads of 250,000 Rand. Here we see we have an under recovery of 50,000 Rand. We can then calculate our actual gross profit and deduct our non-manufacturing costs to get our net profit of 590,000 Rand. For variable costing, it is the same process. Our sales and opening stock remain unchanged. Our production is now based on the 8,000 units, with our closing stock being null. We can then calculate our variable cost of sales and subtract our variable non-manufacturing costs to arrive at our contribution. We can then subtract all our fixed costs, which were given to us in the scenario, to arrive at our net profit of 640,000 Rand. Notice again that our profits are different and will therefore need to be reconciled. Also, notice that we can conclude that when production is less than sales, our absorption costing net profit will be less than our variable costing net profit. To reconcile our net profits, we can fill in our absorption costing and variable costing net profits. Again, we will work from absorption costing to variable costing, so we need to ask how our fixed costs would have been treated differently. For opening stock, remember that absorption costing would have expensed the fixed overheads in the current year when the units are sold. Variable costing would have expensed it last year when the overheads were incurred. So absorption costing expensed it this year, but variable costing did not, so we need to add it back. Again, the amount we add back is our units in opening inventory multiplied by the 25 Rand being our fixed overhead absorption rate. For the overheads in our closing inventory, absorption costing does not expense them this year, but rather carries them forward to next year to expense them when the units are sold through opening stock. Variable costing, on the other hand, expenses the fixed overheads this year when they are incurred. So because absorption costing did not expense it this year, but variable costing did expense it this year, we need to subtract it. In this example, it is nil because we have no closing inventory. Once again, we have reconciled our net profits. Now, under each example, we saw how profits differed between absorption and variable costing. If we just look at the absorption costing statements, we see that although sales has remained constant, our net profit has changed. This is driven by the changes in the production levels and the impact through the under or over recovery. If production is greater than sales, our net profit is higher. If production is less than sales, our net profit is lower. This is how we can manipulate our profits through production. It also shows that absorption costing net profit is a function of both sales and production. If we then look at our variable costing income statements, we see that the net profit has remained constant despite the changing production levels. Variable costing net profit will only be different if our sales level changes. This is why variable costing is a function of sales only. That brings us to the end of our series on absorption and variable costing. We hope you enjoyed it and learned something. Be sure to watch our other videos, and we will see you next time.